Welcome to the Lady Landlords podcast, where we empower women to gain financial independence through real estate investing. I'm your host, Becky Nova, founder of Lady Landlords. If you're ready to buy, manage, and grow your real estate portfolio, then let's get started. Welcome to this week's episode of the Lady Landlords podcast. I am your host, Becky Nova, founder of Lady Landlords. And today we have a great guest. I am interviewing for you my personal mortgage broker, Brad Dixon of Homestead Funding, to answer all your questions about pre-approval and what's going on with mortgages these days. So Brad, thank you so much for joining me today. I appreciate you making the time.
Absolutely. Thank you for having me.
Of course. So what I always love to start out with is just asking a question about who Brad Dixon is, the man, not the mortgage broker.
That's a good question. Little background on me, just born in Pennsylvania, moved to New York when I was 9. Parents were IBMers. That's how I ended up in the Hudson Valley, where IBM was a big hub. Met my wife actually in elementary school. Known her since then.
Wow.
We have been together since high school. Went to college together. Currently have 3 children. My oldest daughter is finishing her freshman year at the University of Tampa. My son is finishing his junior year at John Jay, and my youngest is finishing her 4th grade year at elementary school.
Oh, wow. That's crazy. Elementary school. So was she in the same neighborhood down the street?
She was down the street. We actually rode the same bus, went to the same elementary school. She was a year behind me, so we went through elementary, junior high, high school, and then she came to college with me as well.
That's great. And then it was really in high school that you're like, yep, this is who I'm going to be with.
Yeah, I mean, we were friends. We knew each other, but, kind of ran around there, but then didn't really get together until high school.
Gotcha. That's interesting. I feel like you don't hear that anymore these days. I feel like now, even my own husband and I, we've been married for 3 years now. We're kind of hey, we kind of miss the whole online dating, the whole Tinder, the whole, all of that scene. So, but you guys that was years before then,
Years before that, yeah. We're definitely
coupled
an anomaly as far as our generation is concerned. I mean, we've been married. We're coming up on 22 years married.
Wow. Okay. Gotcha. So family man here.
Absolutely. Absolutely.
Nice. So when it comes to now being a mortgage broker, was real estate something that was always in your family kind of growing up, or was this something that just ended up being the career path you took when you got older?
Just fell into it, actually. I was actually working a job. My wife, after college, started working with the largest local real estate company in the area. She was doing marketing. She was doing marketing for them. Through different functions and events. I met the owner of the company and hit it off with everyone. And at one point he's like, I'm going to find something for you to do. I'm going to find a job. We're going to work together. I'm like, all right, fair enough. You do that. We'll see what happens. A couple different things came about. I was like, that's not really for me. Then he's like, I'm actually going to start a mortgage company. What do you think? I was like, all right, that intrigues me. Because originally going to school, I had intentions of being a math teacher.
Okay.
And so the math
very
aspect,
different.
Yeah, the math aspect, struck a chord, and I was definitely interested with that, and that's kind of how I fell into it. I had no knowledge of it, no intentions of going this direction, just fell into it and loved it. Been doing it now for coming up on 19 years.
19 years. Did he end up kind of being a mentor for you and really showing you the way to then, because being a mortgage broker also, to my understanding, kind of includes some type of marketing, sales, if you need a book of business and to kind of grow that. Did he kind of mentor you in how to grow that business?
So a little, he actually hooked me up with my then boss, who's actually still my current boss. He hooked me up with him, and he is the one who kind of put me onto the mortgage world. He's been in it for, I think 40 some odd years at this point. So he's the one that pointed me in a direction as far as the book of business, real estate agents, attorneys, financial planners, meeting as many people as possible, throwing that broad net and kind of taking it from there.
At this point in time then, now 19 years into it, do you still do a lot of networking, or do you have a lot of those repeat kind of customers and a lot of those referral partners already in place by this point in time?
So I should be doing more networking, I'm not going to lie. But as you said with the family man, I am a family man. My kids, I played sports. I played basketball in college. My kids all played sports. So, and one of the things that stuck with me forever and why I liked my boss is we basically, his theory when I first met him was we work to live, we don't live to work. So while
Okay.
I have a lot of repeat customers, obviously I've been doing this a long time. So yes, I'm very fortunate that direction. But you know, if there's a game, if there's an event, if there's something that my kids are doing, that's taking priority for me as opposed to going to the functions. So I get out there when I can, but luckily, you know, the snowball's rolling down the hill at this point. So it's keeping
Great.
things busy.
Good. That's fantastic. And honestly, like, it's sometimes with businesses, it is those first couple of years that you kind of have to build that book of business. And then that's the idea, is that you can then continuously improve kind of your quality of life as more money's coming in, as you have those right referral partners, as people are getting to know you and doing business with you, and then saying, hey, this is the person that I want to use again, just like myself.
Absolutely. Absolutely. That's a huge part of it. I mean, that's what this business is all about, really. I mean, most businesses are, but this one's all a relationship business. So it's about doing the right thing and keeping people happy so they want to come back, they want to tell their friends, and they want to, you know, your biggest source of business is going to be repeat customers.
Yes, I love actually every time that I am clearly I'm in Facebook groups rather often, specifically Lady Landlords most of my day, but I am in a lot of other Facebook groups for real estate investing. And I love every time I see your name pop up. There are just various groups that I'm in, sometimes for investors and sometimes just for local homeowners in general that are asking, hey, who's the right person to buy their own personal home? And I just love whenever your name actually pops up there. That makes me just really happy to see and confirms really how much people really like you. So do know that your name is out there, which is really great.
Good. Yeah. I mean, and again, it's even more important with us. I mean, because listen, I'm Homestead funding. Nobody realistically is searching Homestead funding for a mortgage. Okay, it's not like we're not on television, we're not a Chase, we're not a Wells Fargo. So we do one thing, we do it well, and our reputation is everything. I mean, that's going to be the key, because nobody's going to pick up the phone book and say, oh, Homestead funding, let me call them. That's going to be my first number one choice to call. We have to make it
Correct. For me, you could be with company X and I would say, great, I'm going to use Brad because you're Brad Dixon. And that's really, and then it's okay, that just happens to be the company that you're with. That works out great. But that part is kind of secondary to the quality of service that you provide your clients. Now, how long have you been with Homestead?
Homestead, when the heck did I come here? It's a great question. 06, I think December of 06, we came there. So my boss and I were with the mortgage company, with the real estate company, when a lot of the mortgage companies were doing joint ventures and things like that with different real estate companies. That kind of came to a head at one point, and my boss was actually with this company before he came to run that company. And he's like, we're going to go back to this company. We're going to go back to the promised land. I'm like, all right, well, don't forget the small people when you leave. You know, let's go together. Yeah. And that's we've been here. We've been back since in 2006.
That's great. Okay, so once again, that's most of then your career with mortgage.
Correct. Yep.
Okay.
Yeah.
And then where is Homestead? Where can you help people with mortgages? Clearly, I know New York. And one of my favorites was that I referred you to a friend of mine, one of our other fellow lady landlords who was living in New York looking for property here, but then ended up moving to Florida due to the pandemic. And then you were actually able to help her there. So tell me what areas you cover that our members can reach out to you about.
So personally, I am New York, Connecticut, and Florida at this point. But realistically, pretty much up and down the East Coast, whether it's utilizing another person in the office or something along those lines where I'm still the point person, we can pretty much help up and down the East Coast as far as Homestead's concerned.
Gotcha. Okay. That's very, very helpful to know. But then otherwise, New York, Connecticut, Florida are what you do personally. Correct. Great. And then otherwise, anywhere along that eastern seaboard is something that Homestead
can figure it out. Yep.
Gotcha. And I know also you've given me referrals for other states, which has been very helpful too for some of our members.
Yep.
So
absolutely.
Now when it comes to you, we kind of talked about the idea of building that book of business as you, Brad Dixon, rather than Homestead funding. What do you feel makes you different as a mortgage broker compared to some of the other people out there? And I'm going to give my answer too, but I'd like to hear yours.
Realistically, I'd like to think it's the communication. I try to be always available. It's a good and bad double-edged sword, if you will, but if the phone rings and I'm around, I'm going to answer it. If it's a text at night, I'm going to answer it. I mean, I've taken phone calls oddly enough, I've taken phone calls at 1 o'clock on New Year's morning. It's just the way we do it. I mean, I'm fortunate in that I'm not stuck to a desk, and I have the ability to be anywhere as long as I have a phone and a computer. So I take advantage of that. My family has embraced that as well. You know, my kids always joke, we're big Disney fans. We go to Disney World and I have my computer. So they're like, I'm not riding with dad on a slow ride because dad's going to be on his phone and he's going to be checking emails, he's going to be answering things. But on a fast ride, we'll do it because I have to put the phone away. So,
Yeah.
you know, I try to be honest and I try to be available. And I think that's really, you know, the keys to this business. I mean, I like to say I'm a rocket scientist, but I'm not.
Yeah, that's actually, I love that you actually said that, because that was going to be my thing. That was what I was actually going to say. What I find different about you and what I really enjoy working with you is because I know I always get that response, right? And some of our members know sometimes when it comes to business, me and boundaries are not really very good. I am very much a person that if I want to call you or if I want to text you, I'm going to. I'm on the side of, if you answer me when you answer me, right? Like that doesn't necessarily mean that I expect my calls always to be answered. I would definitely not at 1 a.m. on New Year's Eve, New Year's Day. But I'm very much before I forget this, let me send that message, let me send that email, let me make that call kind of person. And I am always been just floored with how fast of response I've gotten from you. From a quality of life thing though, it is interesting because I'm very similar of, let me answer things kind of throughout my day rather than saying, because the other option is to say, great, from 9 to 5, that's it. We can't go to Disney. I can't sneak out to, go to the basketball game early or pick the kids up from school or those types of things. And then you could just say, great, at 5:01, world shuts down. And some people do that. But otherwise, then in your business, it seems like it's more of, great, I'm going to be more of a 24/7, but that gives me the freedom to go to those basketball games, to do those activities on a Saturday, to spend my evenings when a lot of people kind of would want services or would expect phone calls back, that you have a little bit more of that availability within your own schedule.
100%. It also comes down to, as odd as it is, an age thing too. I'm getting older, I don't want to forget. So if you're asking me a question and I see it and I can give you the answer, I'm going to give the answer so that I can move on, and it's not something I drop the ball on or screwed up on that side.
Yep, that was the same with me. I got to send this text now. I understand it's 6 o'clock in the morning, which most people my age these days are usually up. I can't tell you, same thing, how many conversations I've had with friends of mine that I send a text at like 6 and they actually write me back. And it's like, yeah, we're having lunch now. So, so might as well hop on a call.
Yeah, I mean, the only time I don't have it is I do go to the gym in the morning. I'm there by like 7 o'clock. It's the only time I actually leave my phone in the car. I don't take it with me. So it's about an hour and a half or so. Other than that, it's all bets are off.
That's smart. That's actually a really good idea. I might actually have to start trying that myself. I have it on silent, but that's kind of as best as I've been able to get to.
It doesn't even leave the car.
That's really smart. All right. I might give that a try next week. But so that's you. That was what kind of makes you different. But for our members that are listening in here, one of the biggest struggles is figuring out who to really kind of work with. So one thing that I would love for you to kind of talk about would be a little bit between the difference of what a mortgage broker does versus a mortgage lender.
Yes. So we are a mortgage bank, actually. One of the main differences between a mortgage broker and a mortgage bank is that we are in total control of the process. It's our money. It's our underwriter, it's our processor, and it's me throughout the entire process from start to finish. Okay. Afterwards, there's an opportunity, potentially the loan could be transferred as far as servicing is concerned. And that is a more logistical thing, in that we at Homestead don't have enough employees to just be opening mail and logging checks that bills have been paid. So we do eventually sometimes sell loans. We have to keep some on our books based on the government, but we sell loans. A mortgage broker, on the other hand, is really just a middleman, doing nothing more than taking loan A and placing it with company B. Once they place it with company B, the mortgage broker has no control over anything. They're not underwriting, they're not processing. They might assist a person with the process in gathering paperwork, but as far as the overall loan rules and anything that's going to happen with it, they have no control over it. They're just basically throwing you somewhere. Unfortunately, a lot of times the brokers, they're going to throw you to the bank that's paying them the most money. You're not going to know that, but unfortunately, that's how it works. Whether it's a good servicing bank or one that has a nightmare of a process, you're going to end up there anyway, and you're not going to really know any difference. Whereas here, I'm paid a flat fee no matter what. If you get a 1% interest rate or if rates are 10%, my pay is the same. So my job is to do the best job I can for you, get the lowest rate I can for you, and get the job done, which is probably at some times, which if you've ever been involved with a nightmare of a process, the interest rate might be immaterial depending on what the process is like.
Exactly. Sometimes actually getting that loan to go through is a little bit more important than what the actual number is of that interest rate. It once again is that service and that clientele that you get beyond just the actual number, and that quarter of a point or half a point difference sometimes might not be the struggle that you're really facing.
You'd be willing to pay 1 point higher if you're in a nightmare of a process. You wouldn't care.
Exactly. No, but Homestead doesn't have the traditional bank in the sense that I can't walk in, open a savings account or a checking account and see a teller, right? So all this bank would do is just the home loans.
That's exactly correct. We are a mortgage bank, period. We found one thing that we do, and we do it well. We do not have checking accounts, savings accounts, student loans, commercial loans. We are strictly a residential mortgage bank. Anything that you need for lending purposes, we can help you out with. But yes, that's it. There's no branches you could come into or do anything like that.
Correct. Now, how then would you compete, or what would be the decision-making process? Most people are going to say, well, I have my accounts at Chase. I have my accounts at this bank. So I'm going to head down the street. I'll go to my local branch and I'll just open a mortgage there. I feel like you hear kind of those nightmare stories all the time about that. But what would be why somebody would go to you rather than kind of just a place that they feel they have a relationship with because they just have a checking account there?
Yeah, and that's always been that. Listen, that's going to be our toughest hill to climb for forever. The key is going to be individuals like yourself. I mean, the referral from somebody that's gone through the process is more valuable than the fact that, hey, I might have once got a car loan from a Wells Fargo, and I think I'm going to go there. It's a tough sell on our end. Unfortunately, the big banks usually are our best referrers, because we clean up the mess of all of these guys that take them in. I mean, your big bank's going to take it in. You're going to go meet with the person that's local. Then from there, it's going to head to wherever they process loans, North Dakota, North Carolina, Wyoming, who knows. And at that point, then you become a number. And that's where the nightmare can begin. It doesn't always happen, but it can begin there. And unfortunately, everybody thinks, well, I'm going to go to the local branch because it's there. But realistically, that's not where you're going to end up. You're going to start there for a minute, and then it's gone. But it's an uphill battle for us trying to, enlighten everyone that this is really how you want to do this.
Right. And it sounds like then you have somebody more that you can actually speak to. Correct. And go through and then actually walk through what your actual situation is. And sounds like then if there's issues through the process, that it's going to be a little bit easier to get the help you need to make sure that that loan can actually go through. Was that accurate?
That's 100% accurate. And listen, again, we only do one thing, which is mortgages. So guess what? Myself, my processor, my underwriter, we're all vested in getting the loan closed. We don't benefit from, if a loan doesn't close, we don't make money. We don't have that ancillary income coming in from student loans and car loans and things like that we can say, we lost a loan, who cares? If there's a will, there's a way. We're going to look to make it work so that we can keep our company running, is realistically what's going to happen.
Of course. So you said this about mortgage brokers and also about yourself, is really that you're getting paid from the loans, not necessarily from us, the borrowers / buyers. Can you talk a little bit more about that?
Yeah, correct. My company, I have a fee structure set up with my company. They pay me only when a loan closes. There is no money, I'll put it out there. We have one fee, which is $895. That's all we have as a company that shows up on your closing costs. Everything else that shows up on there is all required costs that you're going to have regardless of who does your mortgage, whether it's title, whether it's mortgage tax, whether it's tax reimbursements, anything like that. So yeah, there's no fees or anything involved that the buyer has to worry about that they're going to get hit with from us. And we even pre-qualifications. Listen, we pre-qualify everybody on good faith. We're trying to earn your business, but realistically, we're putting in the time to do that and get you the letters and get you what you need to do. And we have nothing to show for it. If you come back, fantastic. That's what we're hoping for. If not, it is what it is.
Gotcha. And then from a mortgage broker side, there's usually a percentage that they would get paid. So they would probably get paid differently, but they still get paid from the loan side. Doesn't cost the borrower anything, correct?
Correct. A broker typically has different rate schedules with different institutions. So they have it set up however that's set up. But again, it does not come from the borrower either way.
Correct. I want to make sure that's clear, just because we do tend to see in some of these groups lenders that kind of reach out and are all of a sudden starting to ask borrowers, oh yeah, this is the fee that like you would be paying me. And they tend to end up being a little bit more from a scam side. So I want to just make it very, very clear that really it is in the best interest of a borrower to make sure where these fees are coming from and not end up getting scammed on that side. But I also like what you just said there also about the brokers, that if they have different rates negotiated with different banks, then they also might have an invested interest in kind of pushing you towards a certain bank, which is in more of their best interest than yours. Not saying that always happens, but that is something to probably have a conversation about.
Correct. It's a potential is there for sure.
Gotcha. So what point in the process should a buyer come to you? Should we go find a house first and go find a realtor and then come to you and say, hey, I need the loan? Should we come to you first? And now, especially these days, you always need a pre-approval pretty much to even see anything. So where do I start? What point should I actually reach out to you?
We are step one. We are jump off. You want to know what options you have available and where you stand. And most agents are going to want to know that as well before they're going to agree to work with you. As you said, you won't get into a house in this market without having a pre-qualification letter. It's not going to happen. But even to save yourself time and a realtor time, you should start off with a mortgage person so that you know exactly what options are available to you, how much money you're going to need as a rough idea, so you can have all of your facts and figures in hand so that you know that you're ready to really start this process or not.
And then when I now pick up a phone, right, I got a great referral, I know you're the person I want to work with, what do I need to get you to then kind of get that pre-approval? What should I have prepared, or what is going to make me then a candidate to actually work with you and to see if I can get a loan or not?
So again, I'm kind of unique in that I try to get more paperwork up front than less. There's still a lot of people in my business who will basically speak on the phone and take numbers as you give me and send you out shopping, whether they might be real or not. And it's not an intentional thing that I'm saying it might be real, but depending on what you do for a living, and if accountants get involved and money gets written off, it could be a whole different game plan as far as what we need to use than what you might be seeing. So it's really not a lot. If you are a salaried person, what I like to see is just the last 2 W-2s, and I like to see 2 pay stubs. We are unique in that when I pre-qualify somebody, we're actually very unique that I don't even know of anybody doing it. We do a soft pull of credit when I pre-qualify somebody, so it does not impact the credit score. Most that I know of, I'm not saying 100%, but that I know of are doing hard inquiries initially up front. We don't do that. So salary is just 2 pay stubs, 2 W-2s, and you can just tell me how much total money you look to use. I don't look to get bank statements, because I feel if you know you have 20,000, you have $20,000. If you don't, then we might have bigger issues.
Exactly.
Yeah, and it gets a little trickier if you're self-employed. Then we have to bring in tax returns or business returns or things like that, depending. But it's the rules of 2s. It would be 2 tax returns, 2 business returns as well if you have separate. And then we go from there. It's not a lot, but a little bit.
And once again, this is for the pre-qualification.
Correct.
Right.
Correct.
So to start up front, that kind of helps. So let's talk a little bit about the self-employed people, the people that work off of tips, maybe some freelancers. Are those people that can still work with you to be able to get a mortgage?
Absolutely. I mean, we have to get why I like to get the information up front is to get us a jumping off point. I want to see what you've claimed, what you've done in the past, how your accountant handles things, and see where we are right now. Now, maybe we're not in a position right now based off the last 2 years to do something, but at least now I see how it's been done. I can guide you on maybe what you need to do moving forward to put yourself in a position, because again, not everybody is going to be available and able to buy something right off the bat, but we have to start somewhere so that we can get you where you want to be.
Are there either credit scores, or we always hear about like debt to income ratios that are just kind of like a hard no, we need to definitely make some improvements there, versus what is going to be something that there's going to be an easier yes to? Like, is there kind of a line that you look for of what can get through versus what can't?
I mean, a lot of it, unfortunately, is situational in that it depends on, what type of property you're buying, what your credit score is, what the loan amount is. But a rough idea is you're not going to go above 50% of your gross earnings as far as the debt to income ratio is concerned. So there's just going to be no options, no matter what the situation is there. If we're at 50% or less, depending on the other factors, there's a good chance we could probably find something to be done.
Okay. And within that debt, we're talking student loans, medical debt, what else, like credit card debt, car loans, everything like that, correct?
So the debt to income, it's anything that shows up on your credit report. Okay, so yes, that's going to be minimum payments on credit cards. That's going to be student loans. That's going to be car loans. That's going to be anything there. But we're not going to worry about, insurance costs or car insurance or heating bills or anything like that. It's all strictly based on credit report driven items.
What's on your credit score? Gotcha.
Correct.
And then within credit scores, does that affect which types of mortgage products you will have access to?
Yes, yeah, different mortgage products have baselines as far as credit's concerned. You might run into debt to income restrictions based on your credit score. Like I said, the 50 is a rough idea, but depending on where the score is, it might be limited to a 45 or a 40% debt to income ratio. So there's really 4 factors that go into your overall interest rate and things like that. It's going to be your credit score. It's going to be the type of property you're buying. Is it a single family? Is it a condo? Is it a 2-family? Is it a multifamily? It's going to be the reason you're buying, meaning is it going to be owner occupied, a second home? Is it going to be investment property? And then it's also going to be the loan to value. Those 4 items kind of go into the overall approval, overall interest rate, and how things are going to shake out.
Okay. And then when we talk about kind of these people in certain different situations between either self-employed, freelance, also one of the situations that's happened over the past 2 years is a lot of people were laid off. A lot of people became self-employed. A lot of people were just out of work or maybe deferred their student loans, but now we're kind of back at work, or maybe they completely changed fields. Are people in that situation, are they able to still get loans out if they just recently went back to work? Or is there some type of waiting period between either changing careers or then being laid off and now returning to work due to COVID?
So 2 answers. Is if you're a salary / hourly employee who may have been laid off, had a gap of time, now you're back to work, not really. I mean, it's like 30 days, but realistically, that's not a waiting period, because by the time you give us a pay stub and start looking out there, it's going to be over anyway. If you happen to be a salaried person who maybe then started your own business in the same field or went along that lines, or a 1099 in the same field, then you're probably going to have a year waiting period, because again, it comes into the accountant situation. We have to see how the overall income is going to be affected when you're writing off your own expenses and things like that. But realistically, it's not too bad, even given the pandemic and what's happened. There's not too many more restrictions. We basically can write off the issue that there was a gap based on the pandemic. It's kind of a known thing, so it's not unheard of.
Exactly. Yeah, it's not exactly a unique situation that
Correct.
we're not working in 2020 or 2021, even possibly even into 2022 now. So when I call for that pre-qualification letter, is that a time when I should mention to you, hey, this is going to be an owner occupied property, this is going to be an investment property? Do you ask those types of questions at that time?
Yes. So along with the request of the paperwork, what I will do is I also send a link to my website, because everything can be done electronically at this point. And from there, that will kind of get some basis. The reason I really send that out is because, number one, I do math and typing and things like that are not my strong suit. I can take care of it, but I'd rather individuals put in their own name, address, social, date of birth, things like that. So I'm not responsible for that end. And then within that, it will be, what are you looking to purchase? Is it an investment property? There's some basic questions that you have to answer in order for it to be completed and submitted to me so I can take it from there. But I also address it as well as part of the phone call.
Gotcha. And so now, okay, now I got pre-qualified, I got my information, and that gives me really then that information of what type of property, what types of mortgages I can possibly be able to get. And then also that tends to give a bit of a cap, right, of what I can actually spend on a property.
Correct. Yeah, it's going to give you, it's basically a jumping off point. Okay, which
Yes.
I tell pretty much everybody the same thing. It's a jumping off point, and I tell them roughly what numbers I used to make it work. But I let them know that it's nothing more than something to get the ball rolling, because on the phone before we have a property, we could play what if games forever. What if the price is 500,000, taxes are 9,000 or 8,000 or 450, and who knows if it's real? So we get a rough idea. We know that it's feasible. We know you're in a good spot. Then from there, it's time to hook up with a realtor and kind of see what you can find. And then I always leave it up to them. I say, listen, as you find properties, send them to me. I'll run the numbers based on real facts that we have. We'll have a listing price, we'll have taxes, and we know your scenario. So I can say, hey, your payment's looking to be X, your total out of pocket's looking to be Y. If you're happy with it, go get it. If you don't like it, move on to the next one.
Is that something that you feel a lot of mortgage lenders will do? Take a look at specific properties and help kind of calculate out that information?
Unfortunately, I would say no. I would say that
Okay.
goes around to one of the things that kind of sets us apart. A lot of people just want to say, hey, go do it. Don't talk to me until you have a house, and then you can let me know. Where again, it's too big of it's the biggest purchase of anybody's life at the given time. Whether it's going to be bigger next time, it could be, but for that point, it's going to be the biggest purchase pretty much anybody's ever made. So you want to know, and I want you to be comfortable, because what I, as a bank, might say you're comfortable with might be completely doesn't jive with what you're comfortable with. And we've got to make sure that fits, because if I send you out looking for $500,000 with $12,000 in taxes, that payment could be $500 a month more than what you want. So we've got to know realistically where you want to be so we can all be on the same page.
I think that's something important to think about too. I feel like most people don't realize that all because the bank will give you a loan for a certain amount of money does not mean you have to actually buy a house for that amount. We can buy properties for under the budget that a bank gives us.
100%. Because listen, as I tell everybody else, I'm not making the payment. After we close, it's you have to be comfortable making the payment. That's not on me. That's on you.
Yes.
You got to know where you're at.
No, and that's definitely important also, once again, from that investment perspective, when we are out analyzing deals and looking really to be able to bring in that cash flow, all because we are able to get a loan for something does not necessarily mean that has to be the budget that we spend. We can spend up to that amount, but there are deals to still be had under those prices very often.
Well, correct. As you've seen too, and sometimes even if you, from an investment side, even if you go to that top tier price, the profit might not be as good as something that's less expensive than what you're looking at. It all comes down to realistically what the numbers are to see how you want to do it. The price is immaterial at that point. It's all about what's going to come in.
So let's talk a little bit about with the different types of mortgage products. One thing that I feel like always gets investors kind of stuck is the idea that they have to put 25% down. Is that still industry standard for a non-owner occupied property?
If you're doing a conventional loan from 3 to 4 families, unfortunately, yes, it is still 25% down. If you go to actually I'm lying, it's 2 to 4 family, yes, it absolutely is 25% down. The only small time you get, which doesn't really jive a lot as far as income is concerned, a single family investment property, you can do 15% down. So it's a little less forgiving, but a lot of times the income that could be derived from a single family doesn't always make sense. But unfortunately, it's still a lot of money as far as an investment is concerned.
Right. Okay. And that's something that at least I could say I took a little bit of advantage of that, because that's something that has really changed in the past couple of years, right? Because I feel like a lot of investors are hearing people say, but no, back in 2019, I bought a multifamily investment property and put down less than 25%. But that's just times have changed, right?
Correct. I mean, we're all, for the most part, which I tell everybody too, as part of the process, we're all governed by Fannie and Freddie, which is the government. So if you could figure them out, we would all be much better off. But yeah, things change like you change your socks. They come in, they come out, they change programs, they like it, they don't like it. And it can change any day. It realistically does all the time.
Change any day. And also sounds like there's not necessarily always a justification given with what these changes are. Sometimes maybe we could piece it together. Clearly a pandemic is, maybe reason to make some changes, but in general, it's not like, once again, the federal government tends to give us an understanding of decisions that they make.
No, exactly. We always joke, it seems like they're throwing darts at the wall sometimes. This change came from here. Why?
Yep.
Common sense is out the window, but we have to deal with it. We have a saying here, it is what it is. It is what it is. It's the rules we're given. This is what we have to follow. You choose not to, then we don't have to do it, but we have no choice. It's not like we make up our own rules. We have to follow what they give us.
Right. So multifamily, 2 to 4 units. If it's an investment property, 25%, not 10, not 15, not even 20. Nope. 25% is the number you're looking at.
Correct.
So let's address something that I see rather often or hear about people doing, which is looking for that owner investment, that owner occupied property that they now are like, great, I can put down that 3-5%, but they want to use it as an investment property. Can you share a little bit about why that is not a good idea?
As far as you're talking about buying it as an owner occupied, but investing it. So,
because 5% down sounds much better than 25% down. I'm buying in New York. These are big numbers, but there's clearly reasons we do not want to be doing that.
Yeah,
so
I mean, the main reason it comes down is the nasty word called mortgage fraud. So that's realistically the biggest deterrent. And as crazy as it is, if you get brought up on charges of mortgage fraud, it's actually, and I'm not even kidding here, it's worse than murder. They can be $1 million fine and 30 years in jail. Wow. If they come after you for mortgage fraud. Now, I'm not saying they will, but realistically, that's what you're up against. It's not anything to play around. Now, if you're going to live in it for even a year, it's okay. You can do it that way because there's no maximum amount of time you have to live in a property for it to be on owner-occupied property. If you're moving in, as long as you can live there with occupy within 60 days, if you leave in 6 months or 7 months or 8 months, it's okay. There's no restrictions on that end. But you don't want to just flat out lie that says, hey, I'm going to put down 3.5% and I'm never, ever going to live here. And there's also some things people should know about. There are sometimes post-occupancy checks. Sometimes some investors, some banks will say, hey, Becky, let me see that utility bill from the house that you just got, and you don't have one in your name. And guess what? Now you're in some troubles.
Yes, I've actually met somebody that is their sole job.
Yep.
Is working for a mortgage company, checking up to make sure that people are living in their owner occupied properties. So, because that's what I hear all the time. People are like, oh, but no one's going to come check. And the answer is actually, there are people that their sole job is to do just that.
You are correct. I mean, the odds are they probably won't get there, but that's a gamble you have to be willing to take. And it can be a huge gamble if they actually figure it out.
Going back to that whole, this is probably the biggest purchase you're ever going to make in your life. Yeah, maybe not something that you want to necessarily play around with.
Put the gamble on. Yeah, it's not like a pack of gum here. We're putting some big dollars of gamble at risk here.
Yeah. So now, okay, now I got my pre-approval. Now I understand that I'm putting down my 25% for my investment property that I am not going to be living in. I go out, I find my property. Perfect. Got it. Got my accepted offer. At what point does this come back to you now?
Basically, what I tell everybody is 9 times out of 10, everybody's doing a home inspection. So realistically, I say we can start our process once the home inspection is done. We just want to make sure there's no deal killers in there, any foundation issues, or something that's going to make you walk away from the property. Most inspections find something, but that's immaterial if it's little. But once we know the deal's good and there's nothing that's going to kill this deal, at that point, I like to get the ball rolling on our end while they're working on contracts on their end as well, so that things are simultaneously getting moving.
And what can I do as the buyer at that point of time to make your life maybe just a little bit easier?
It really just comes down to the communication. I mean, there's going to be paperwork we're going to need, and there's going to be things we ask for. So the one thing we do run into a lot, which is interesting, is just make sure you read and make sure you follow directions. So a lot of times bank statements, we'll ask for all pages of bank statements. Sometimes we'll get page 2, 4, and 6. And we're like, no, we need all bank statements. Well, you don't need that. But no, we do need it. That's why I'm asking for it. I don't just pick on somebody to figure it out. So it's realistically just, like I said, following through and making sure you're diligent and on top of it, because we're here to help you. I want to help you get the house. And there's going to be certain things in the contract, like dates that a commitment letter has to be done by. There's target closing dates. There's things within the contract that we have to meet to keep your process going. And we're just trying to help you facilitate that. So we just want you to help us as well.
Yes. One of the things that I personally do is I have certain folders that I keep on my computer that have all of those documents. So that way I can just upload them into the portal, shoot them over, that type of idea. If you're interested in seeing what some of those documents may be, you can head over to our website, lady-landlords.blog, and you can actually read what some of those documents are that you want to have on hand to be able to send over to your lender. So that's just a good resource to be able to use there. But that, to me, I keep all those documents there. So in that way, great, I have electronic copies of my taxes, of my bank statements, everything that I need to be able to get that over to you, because I know that you have deadlines you need to meet, and I got deadlines I need to meet. So now, within kind of coming hopefully a little bit out of pandemic here, how do you feel that pandemic changed lending? Once again, we already talked about how now down payments became more strict. Did you see that within the ability to fulfill other loans?
Coming out of the pandemic, not really. I mean, there were some nuances we had to deal with while we were in the pandemic. Certain ways we had to calculate income and utilize some things. But now that we're out of it and everybody kind of knows, looking back, what happened, we don't really have any new guidelines or anything that's come across that has changed our lending standards really too much.
That's great. Okay, so kind of back to status quo, except for now 25% down on investment properties. We got that to keep. Okay.
I think it's going to be here for a while, because realistically, listen, an investment property, just so people understand too, an investment property from a bank is one of the riskiest loans that a bank will offer. And the reason being is, take a step back, forget that it's the bank. If something happens in your own personal situation, what's the first thing you're going to let go? Well, you're not going to let go of your primary residence, right? You probably won't let go of your second home. It's going to be one of these investment properties. I'm going to say, I can't afford it. I can't do anything with it. I'm going to let that go first. I don't even live there. So that's realistically where it comes from. And if people understand that, it kind of justifies why the down payments, that we want you to have a little bit of skin in the game before you're going to be able to say, well, I'm just going to walk away from $50, $70, $100,000. Not a lot of people are willing to do that when they have some skin in the game. Right.
No, that makes perfect sense. So one of the other things that I guess we are now experiencing is a change in interest rates. So you have a lot of people that are really freaking out now that they've been at just historic lows. I mean, really, the rates that I hear that people have been getting over these past couple of years is just crazy. I've been fortunate enough to also benefit from those. So can you talk a little bit about why this is happening and what you think maybe we can expect over the next couple of months?
So rates are rising based on the inflation in the US. With inflation being so high, what happens is they have to slow down borrowing and slow down the flow of money in order to control inflation. So take a step back real quickly, is that everybody hears the Federal Reserve raises rates. That does not necessarily impact mortgage rates one for one. Okay, when the Federal Reserve raises rates, that's on short-term borrowing. So that's on your car loans, things like that, that is having your home equity loans, things like that will have an immediate one-to-one impact almost when the Federal Reserve does that. And they do it to slow down people from buying stuff. So if car loans went from 0% to 6%, it might slow down, I might not buy a car. So they're trying to slow down everybody from spending money. Now, it also did have an impact on rates. Rates were very, very low, as you said, for quite a while. So they actually needed to come up just from a regulating the market type situation. They've shot up a little quicker than I thought they would. But realistically, from everything that I'm watching and reading, I don't think they're going to fluctuate a lot from where they are right now. I think they've hit a spot. I think they're going to stay here because, again, it's like everything the government's involved with in the Fed, it's a tightrope they're walking. If they raise mortgage rates, if they allow mortgage rates to get too high, then that will completely shut down the housing market. And the housing market is one of the biggest overall contributors to the economy, in that you have houses, you have Home Depot, you have everything that's involved with owning a home, makes the economy flow. So I would anticipate, again, if I knew the real answer, I'd probably be on an island right now, and I probably won't be having a conversation with you right now. But based on everything that I'm watching and seeing, I don't anticipate them changing a lot from where they are right now.
Gotcha. So with where the rates are now, since they clearly have increased, should investors kind of hold off on buying? Is this still or what do we now do with that change in interest rates? Because most people are not seeing prices drop. So it's almost now costing a little bit more, especially for those of us that are trying to, once again, make money by doing this. Right now, we got housing prices are still up and interest rates are still up. What do we do at this point?
So I think a lot of it depends on the market that you're in. I mean, given the New York market, I think it's still a time to buy. If this is the direction you're going to go, you still hold the course. And the reason I say that is, yes, interest rates might be high, but as we've seen for the past 2 or 3 years, prices have done nothing more than keep ticking up, ticking up, ticking up. And again, my opinion is, in most of our market, Dutchess County, where I'm at, down to Westchester, Putnam, is the reason prices have ticked up is there's no inventory. It's a lack of inventory, and there's no major influxes of inventory that I see coming on the market. There's no big construction, projects going on that all of a sudden we're going to have a lot of houses coming on. So that's going to still mean that prices are still going to tick up, and paying the higher interest rate, even if it's 2% over where it was, is still going to be cheaper than waiting a year to find out that the price went up $75,000. Because now you might be still the same rate you're at now, but you lost $75,000 because prices still climb and climb and climb. So I would still say you hold the course. You have to fine tune the numbers a little bit more to make sure that the project is still making money. But I think it's a way to go.
Well, that's it. I mean, investors were making money, 30, 40 years ago when interest rates were 10, 11, 12%.
Correct.
So as a person that invests in New York, I feel like between the interest rates and also taxes are two conversations I have with other investors all the time. That they're like, oh, why do you buy in New York? Taxes are so expensive. And to me, if I can still make that cash flow, I really kind of don't care what my taxes are. I don't really care if my interest rate is higher, because I'm still making the amount of money that I'm looking for. Does it change then the deals that I could possibly find? Sure, it might have an impact on it. But once again, it's not like interest rates doubled overnight. It's more prices that have actually increased, which is making a bigger impact, in my opinion, than really the change in value or the change in cash flow that I can really get from a interest rate. So I'm with you. I'm currently looking to buy other properties too. So I agree with you. If the numbers still work, it's a good situation to move forward. So Brad, thank you so much. I really appreciate you answering so many of my questions today. I still feel like I have like 100 more that I can ask you about. So we might have to, as I say, we're going to have you come back on another time. But Brad, thank you so much. I appreciate it. I will make sure to put Brad's contact down in the show notes for anybody that would like to reach out to him to discuss using him, which I highly recommend for your next loan. Otherwise, please do make sure to subscribe to the Lady Landlords podcast if you listen to us either on YouTube or wherever you listen to podcasts, so you do not miss an episode that gets released every single Tuesday. Thanks so much, and see you next week for our next episode of the Lady Landlords podcast. Thank you for listening to today's episode. If you're feeling stuck in your real estate journey, visit lady-landlords.com/roadmap to book a one-on-one workshop with me. I'll help you determine your next best strategy. Or you could subscribe to our newsletter for exclusive tips and offers. Invest with confidence. Become a Lady Landlord today.